What are you kind of looking for from the Fed? How are you thinking about what their next move might be?
Well, I'm certainly of the mind that the Fed is not thinking seriously about raising short-term interest rates as long as they're doing quantitative easing. So the taper was thought to be impossible for anywhere here in calendar 2021, but there's whispering behind the scenes. Some of the Fed officials are thinking that maybe they should start tapering even as soon as next month. I don't think that's going to happen. I think they're going to wait and see. They're clinging to this transitory or temporary inflation thesis. They've already been wrong on that. When they talked about this bump in CPI and other inflation being temporary, they kind of define that as being 2 or 3 months. But it's already been more than 2 or 3 months. Now they're talking about 6 or 9 months. I think if we go into December, if we end the year 2021 with inflation on the CPI headline above 5, which is about a 50-50 proposition, I think. We're at 5.4 right now. If it stays for the year at 5, then I think the Fed may start tapering, because the transitory inflation thesis will be very hard to defend at that point. Keep in mind that the PPI, which is wholesale prices, which lead CPI, on the headline are 9.6 or something like this. I know it's a 9 and change, and on the headline it's 4.3. So the Fed policy is going to depend completely on whether or not these elevated inflation levels can endure. And with commodity prices having stabilized but not dropping, I think it's a fair bet that inflation is going to continue to be stubborn on the upside. And with that happening, taper becomes more of an issue and more talked about. But I don't expect tapering is going to happen. I would think maybe December at the earliest.
Mm-hmm. Jeffrey, my colleague Brian Sozzi has a question for you. Brian?
Jeffrey, yes, just following up on what you were saying about the Fed, given that you do see stocks as overvalued, when the Fed does taper, how disruptive do you think that will be to stock and bond markets?
Well, it certainly would be negative for the stock market. As I pointed out, the expansion of the Fed's balance sheet goes in lockstep with the capitalization of the S&P 500. And when they tried to taper in 2018, the stock market had a sort of mini crash. It actually went into a very compressed bear market in the fourth quarter of 2018, and it forced the Fed to completely change their activity. So it has a negative effect on the stock market. For bonds, what's weird is when the Fed is tapering, historically, yields have actually fallen. It's weird. It's kind of counterintuitive, but historically, that's been the case, that yields have fallen when the Fed has tapered. And now since the Fed has been expanding their balance sheet, actually, Treasury rates have risen. They were at a crazy low level once we went into lockdown. The 30-year Treasury bond actually got down to 1% on a closing basis. And then the Fed reacted with massive stimulus. And now the 30-year Treasury bond, it's not tremendously higher, but it's up at about 1.85 or so. So as they've been doing this quantitative easing, stocks have gone up and bond yields have modestly gone up. And so counterintuitively, a lot of people don't understand. They think if there's tapering, bond yields will go up, but historically the opposite has been the case. So it would probably mean bond yields stay subdued and stocks would fall.
Jeffrey, I have one question for you on the economy, and I'm so glad to have you here today. So we had consumer sentiment crater just the other week, yet we also have job openings at 10.1 million, which is incredibly high. And then when you look at GDP, we're essentially flat from Q4 of 2019, yet we're flat, but with 5.8 million fewer workers. So productivity has gone up. How do you kind of think about the overall economic picture here, especially given all of that as a backdrop?
Well, the economic picture is very, very hard to divine ever since the government got so involved in the economy, and they've made so much. It's like pushing on like a waterbed or something. If you push on the side of the waterbed, the other side goes up and weird things happen, and you can't really compare it to a time period where you're not pushing on the waterbed. So it's very hard to discern what's going to happen. But certainly the employment situation that you point out is really fascinating, and it's kind of seminal to the screwed up nature of the economy. Everywhere you go, almost any profession you ask, they say that they have a hard time getting workers. Well, no surprise. People are making more money or the same amount of money by not working, and the government continues to support that. So what will happen when these stimulus programs ultimately end, or people actually have to start paying their rent? There's going to be tremendous economic disruption. The officials have a tiger by the tail, and for now, they are not getting clawed or mauled by the tiger. But if you let go of the tail of the tiger, you're going to very likely get mauled. And that's what's going to happen. If you ended you don't have to pay your rent, the eviction moratorium, there's going to be all kinds of consequences to that. Rents are going to go way up if that happens, I think. Also, people are relying on stimulus, and the stimulus is responsible completely for this economic growth. GDP is 70% consumption. And as this economy has rebounded back on a GDP basis, it's done so with tremendous increase in the trade deficit. Multiple percentage points of GDP have come from an increase in the trade deficit. And that's not real GDP. Consumption is not really the economy. The economy is about production. And when you buy goods produced in Asia with stimulus money, it shows up as GDP, but it's really Asian GDP. It's consumption in the United States. So the economy isn't really that strong. As you point out, with 5 million fewer jobs, it shows up as correctly mathematically in the productivity equation, but it's really Chinese productivity. Because again, if you just consume goods, you're not really having economic growth. You're just having consumption, but we define it as economic growth. So it'll be fascinating to see what happens when these programs end. I saw that the $300 unemployment supplement is being curtailed on schedule, but states still have a lot of money that hasn't been dispersed. So the stimulus on states' discretion could continue longer, even though it's now no longer being funded weekly by the federal government. But when it all ultimately ends, we're going to see, well, this is people talk about the stimulus and the Fed's low interest rates as a punch bowl. And certainly this has been a very deep punch bowl, spiked pretty heavily, with 100 proof liquor. And once this party ends, the hangover is going to be in the form of sharp drop in economic growth. I think one of the reasons consumer sentiment dropped so much, just cratered at the most recent reading, has to do with the fact that people are aware that maybe the stimulus is getting a little shakier in terms of our ability to predictably rely that it's coming again. And also the misery index, which I think Ronald Reagan created, which is the sum of unemployment and inflation. Once it goes over 10, they call it misery, and it's at 11.3 right now, the sum of CPI, headline, and unemployment. And maybe the consumers are feeling the inflation. I think people are starting to realize that inflation's out there. If you ask people, what is the big thing that's worrying you about the economy, overwhelmingly right now, what comes across is inflation, because people see it at the gas pump, they see it at the supermarket, and as long as there's stimulus happening, I see food inflation is continuing.
Well, Jeffrey Gundlach, founder and CEO of DoubleLine Capital, I thank you so very much for stopping by Yahoo Finance Live today.